The broadcast is now starting. All attendees are in listen-only mode.
Good morning. Thank you all so much for joining us today for our new quarterly webinar series titled CIO's Corner, Quarterly Update with our Chief Investment Officer, Chris Gauthier. For those of you joining us for the first time, my name is Amanda Murray and I am the Client Service Associate for Stonehearth Capital Management. I have been with the firm for 3 years and my primary role includes client service, marketing, and compliance. I am happy to assist Chris this year with his quarterly update webinars. I would like to start off with a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will be monitoring all questions and will ask Chris to answer as many as he can at the end of the webinar. If we run low on time and are unable to get to all of the questions, Chris will reach out to each person directly after the webinar to make sure that we get your question answered. Now I would like to introduce our speaker for today. Chris Gauthier is Stonehearth's Chief Investment Officer. Chris brings more than 15 years of investment management experience to our firm, working with both institutional and individual investors. He is responsible for setting the firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking to us today.
Thank you, Amanda. Thank you for that wonderful introduction. Thank you for all for joining us today. Coming here from snowy Massachusetts. So, a little bit of a covering here, but to be expected is January and winter months here in Massachusetts. So like Amanda said, this is a quarterly series that we run. This is our second iteration of this. So again, what this is really meant to be is a way for us to interact with our clients and potential clients and really the public in general to really understand what we're thinking about in terms of what's going on in the markets, what's happened in the markets, where portfolios may be positioned, where we're finding attractive asset classes, and maybe some unattractive pieces of the market too. So again, I would like this to be as interactive as possible. Even though I have a set presentation with set slides, any and all questions readily taken. Anything you want to ask, with one exception. Due to SEC guidelines, I cannot comment on anybody's individual's portfolio performance. If you have any individual questions on any of your portfolios or any individual portfolios you may hold, you can please give the office a call at 978-624-3000 and we'll be happy to discuss that. So with that, let's jump in to see what we're going to cover today. So what we're going to cover today is asset class performance, review of the past quarter, and since it is the end of the calendar year, we'll review what happened in 2017. Long story short, almost everything in the world was up, and we'll kind of go through why that is. Don't think that's going to continue here in 2018 and 19, but again, we still see a strong environment for asset class performance across the board. We'll go over the current investment environment, what we're seeing in terms of risk in the marketplace. We'll take a look at our internal risk model that we use to observe risk, not predict risk, and that is a very important assumption. I don't think anybody can make a living predicting where the market's going to go over the next 2 months, 3 months, 6 months, 2 days. But what we can do is we have certain tools and indicators that we can use to observe how much risk is in the marketplace and position portfolios to take advantage of that risk that's in the marketplace, because there is no return without risk. And then also portfolio positioning. So given what we see in the investment environment, given what's happened, given the probabilities of what's going to happen, how our portfolio is positioned to take advantage of this market. So with that, let's look what happened. So what we're looking at here is fourth quarter 2017. First thing that jumps out is that almost everything was up. And again, this is really just a continuation of what 2017 was like in general. We saw a synchronized rise across asset classes. This really supported a buy and hold strategy, and we didn't make too many adjustments to our portfolios during the year or the quarter. And again, we've been in a current environment for the past few years with easy monetary policy, growth picking up. It may not be robust, and we can, differ on what robust means, but we are seeing growth across the board in most of the asset classes. So if we look right here, what we have on the screen here is in yellow is what we call alternative asset classes. So that would be oil, gold, commodities, the dollar. And you can kind of see at the bottom here, the dollar and junk bonds, otherwise called high yield bonds, were the really only negative performing asset classes in the fourth quarter. It was really led by a rise in oil, and again, we saw the synchronized global growth start to kind of come to fruition. People bid up oil. We also had some supply disruptions over in Europe where some pipelines burst and there was a limited amount of supply coming online. We saw the big rise in oil. We think this is an anomaly. This isn't a sustained change in oil. Again, we still see commodity as more of a trading range than a synchronized rise up, but at least for the fourth quarter, oil was the best performing. Right after that, something we're very high on is frontier markets. Again, the best way to kind of describe this is you have developed markets. You think US, France, England, Germany. Then you go down to emerging markets, which we have good exposure to too. And you think more about Korea, Taiwan. When we start talking about frontier, we kind of go to the next tier down, Kuwait, Abu Dhabi, Nigeria, some of the African countries. The best way I was kind of told about this, the way to think about this is if you're in a developed country, you drink tap water. If you're in an emerging market, you drink bottled water. If you're in a frontier country, you drink Coca-Cola. So that's kind of the way to think about that. Looking towards 2017, it's a very interesting chart. Again, everything was kind of up. But what we saw was a real big change from the past years was that these green bars, which represent international exposure, frontier markets, emerging international, really started to overtake the US. This is just something new that kind of happened in 2017, and we've seen that before where the US was really leading the world in terms of price performance, and we had this thesis here that international, emerging, frontier would start catching up, and we're starting to see that. We don't think this is the end game. We think there's some more room to run here in terms of the international exposure, and we'll kind of get into why we see that. The best performing was US equity momentum. That's that big tall line, 37.6% right here. When you see that, again, we do a lot of factor analysis here, factor investing, characteristics of individual asset classes that have provided returns. Momentum is one of those. But when you're looking at momentum and you're thinking about it, what you really want to think about is growth. Momentum was the growth stocks. Then that leads you to the FANG stocks, Facebook, Amazon, Netflix, Google, which is now called Alphabet, but I still call it Google. I don't think I can ever really adjust to the Alphabet name. Those are the stocks that really led the marketplace. We don't think that is sustainable. I think that is getting a little bit long in the tooth. The trade was there a few years ago. Really don't see that continuation. We really do think value, which is kind of the emphasis of growth, the difference, really is the place to be going forward. So these asset class performances was really driven by the continued easy monetary policy of the federal banks across the globe, the central banks, and we'll look into that a little bit more when we get into the presentation a little bit more here. And also we've seen the synchronized global growth across the world. Everything is working. So we look at PMIs, which is Purchasing Manager Index. It's a survey done by third parties and governments. And basically what it just tells you is the individual country's manufacturing base growing, staying stagnant, or declining? And to the T across the globe, we're seeing increases across the board. So again, a really good synchronized global growth story. So that's kind of what happened in terms of 2017, the fourth quarter. You throw a dot at the wall and you probably got some type of positive performance here. So let's look at the current investment environment, what we're seeing out there. First thing is we're in the midst of a very strong technical backdrop. When we say technicals, we're really looking at price performance, pieces of the market that are performing, how much of the market is performing, and we'll give you some examples of what we look at. But all in all, taking in total consideration, we are in a very strong technical backdrop. Valuations, as we're going to see, are no doubt stretched. They have been for a while, but there are little pockets of assets trading at somewhat reasonable valuations if you know where to look. Again, we're going to look into the emerging markets, frontier markets, going kind of a little bit off the reservation, a little bit over to the international world to get some of the better valuation levels, which should translate into better performance going forward. Economic, again, we're seeing continued economic expansion across the globe, here in the US as well. We'll show some numbers that show this. And again, when we look at economic numbers, we're looking at the totality of the economic numbers. So anybody's individual case may be different. We're looking at the aggregate. So when we show that light vehicle sales are increasing, they may not be increasing everywhere across the US at the same rate, but when taken in aggregate, we're seeing some really good, strong economic expansion out there right now. The other one is central banks. They're still in control. They have been since the crisis, and we'll look at what they're doing with their interest rates. And again, higher rates are coming. but the rise is off a very low base, which will show you that even though higher rates usually are negative for risk assets, it really depends where you start. And we're coming off a very low base. We've been abnormally low for so long that a small rate rise, or even the 4 rate hikes we expect from our central banks here, we won't think is going to dent the market. What we're really looking for is unexpected rate rises, so something that the market doesn't expect, and we'll kind of go through that. So again, the last few years has been about the amount of risk you're taking, you know, how much risk is in the portfolio, and it really has benefited people who just take risk blindly. Invest in the highest risk assets, close your eyes, hold your nose, and hopefully everything works out. That's been great in the past few years. We don't think that is a viable investment strategy going forward. It's really going to be about where you take the risk. You know, what asset classes are you overweight, what asset classes are you underweight, and how you get exposure to these multiple different asset classes. So let's look at our internal investment model. So this is Stonehearth Capital Market Risk Model. We put this together every single month. And again, it's a combination of a bunch of different indicators, and we'll go through a few individual ones. I'm not going to go through the whole thing, but I am happy to do that with anybody. So if anybody wants to call the office, stop by, have a presentation on this, I'll be happy to go through each individual indicator. But again, like we mentioned, the first piece of this is 12/31/2007, our score was 5. So again, when we look at this, we see positive numbers, we see economic growth. Doesn't mean a bull market, doesn't mean everything's growing good, but when taking all the data points that really matter to risk assets, that is pointing to a positive risk environment. It's not predicting where risk is going to be 6 months from now, a year from now, 2 years from now. It's just taking all these data points, given what we know historically, what's happened in the market, where are we in terms of the risk scale? And right now we're in a positive risk environment. So we want to take risk in our portfolios. We just want to be very intelligent about where we take risk. So we have a history going back here, starting 9/30/2017. We have these going back to 2012, but just doesn't really fit on the screen. And you see some small fluctuations month to month. In last quarter, we started off as a +4, moved to a +2, up to a +3, up to a +5. That's just really noise. Again, there's a lot of data coming into these models. There's a lot of noise baked into asset prices when they move either sideways, upways, downways. But again, in general, what we're seeing here, this is telling us that it's a positive environment. So what is the data really telling us? The risk environment favors continued growth, and we want to be positioned for that growth. So let's look at some individual indicators we use. Again, I'm not going to go through them all, but I'm going to take a few ones out of here and just actually go into a little bit more detail. So let's look at the technical picture. So this is my go-to technical chart. This is what I use whenever I kind of start looking at a stock, an asset class, anything. Technical is my go-to chart here. So what we're really looking at here is, sorry about the little line there, is a strong uptrend. You can see it right here. It's just an unbelievably strong uptrend we've seen for a while. And what we're looking here is the S&P 500. Again, why do we use the S&P 500? It's a broadly representative index of a lot of companies trading in the US. And this is kind of what we use to judge, are we in an uptrend, downtrend, or are we trading sideways? And we're trading in uptrends. The other two lines here, the blue line and the red line, are just moving averages to kind of smooth out this performance, get rid of those day-to-day fluctuations and month-to-month fluctuations. Again, what do we want to see here if we're anticipating a strong market? Up and to the right. So everything's moving in the right direction here. A couple other indicators on the chart that we use, and the top one is this RSI. It's a relative strength indicator. It's more of a short-term trading indicator, and what this tries to ascertain is, are we in overbought condition? Do we get too enthusiastic about stocks and people overbought them, or we sold them? So anything above a 70 is kind of flashing a warning sign, saying, hey, maybe we got a little bit ahead of ourselves. And this has been a really good indicator in the short term, and we've kind of seen that in the past 2 days where the market's pulling back here a little bit. And again, it just shows that in the short term, maybe we got a little bit of ahead of ourselves. So again, that is a little bit of a negative on the market, but again, we're still in that long-term uptrend. So we'd like to see this below 70. The other indicator we use down here is something we call the MACD, which is a moving average convergence divergence. What does that mean? What it means is we want this black line to cross the red line. It means that shorter term price performance is overtaking longer term price performance and moving in the right direction, moving upwards and to the right. So again, from a MACD perspective, we're in a very strong market here where we're seeing lots of stocks moving up and to the right, which is what we want to see. So again, looking at this in totality, the technical picture, we may be a little bit overbought. The price performance of the market the past 2 days may be helping this overbought condition a little bit in the short term, but long-term technical pictures are looking very strong, upwards and to the right. We got lots of support from the moving averages. We usually don't see big breaks in the market until they break moving averages, and we're not seeing that. And then we look at the MACD, and we're seeing price performance improve across the board. So again, very strong technical picture. Another technical indicator we use is percent above 200-day moving averages. And what is this? This is the stocks on the New York Stock Exchange that are trading above their long-term averages. And the thesis behind this is when we're looking at individual asset classes, looking at stock markets, we want to see if it's going up, we want to see broad-based participation. We want to see more stocks going up than less. We don't want to see those narrow. And it makes sense. You have much more support when you have a broad base rising than when you have a very narrow base. So think about it in terms of this. If we had 4 or 5 stocks, the top holdings in the S&P 500, say Apple, Alphabet, going up, and the rest of the stocks kind of trading down, you'd see this down here in the 40-50 range, which would not be healthy for the market. But again, up here at 70%, which means that 70% of the New York Stock Exchange stocks are trading above the 200-day average. Historically, when we've seen this number up above 50, we've seen continued uptrends in the market. So this is something we'd watch for a break kind of below 50 to make us a little bit nervous, but we're not seeing that right now. We're seeing broad-based, strong participation in this uptrend. Again, and just the broader the rise, the greater the support. So that's the kind of positive. And now we're going to kind of go into the negative. And we talked about valuations a little bit. There is no way about this. I can't get around this. The market is overvalued. So what we're looking at here is the Shiller PE ratio, commonly referred to as CAPE. So what does CAPE mean? Cyclically adjusted PE ratio. So what is this? It's a PE ratio, price over earnings. So price of any individual asset class. Right here, we're using the S&P 500, and E is the earnings. How much earnings has it reported in the past quarter? What CAPE does, it takes a much longer term view of this and takes the past 10 years of earnings, averages those out, and uses the current price as a numerator. So what this does, it smooths out the business cycles. We all know business cycles are cyclical. They go up, they go down, but using a 10-year time frame is historically proven that you get a better feeling for what the market is being valued currently. And it is overvalued. So we look back, Black Tuesday, hopefully none of us remember this. They've only read about it in history books. Is 1930, we have this big rise up to 30. It's only been more expensive once in its history, and that's right here in the 2000s. And I'm sure most of us remember the dot-com bubble here, and it really got to elevated levels. Right now at 33.72, the market's expensive. It's overvalued. The one thing, and we'll show you kind of in another presentation here going forward, is that you can decrease this a few ways. Price can come down. That's not what we want to see, because that means the markets are going down. Or earnings, the denominator, can go up. And we're really seeing a big, strong rise in earnings lately. And we'll kind of go through some charts to show you that. But again, up here at 33.72, it is very expensive. The one thing caveat with this is that it is not a good timing model. It's never proven to be a time to when get in or out of the market. What it does, again, observing how much risk. So there's a high risk due to the valuation in the marketplace, but it's being offset by those positives we're seeing in the technical backdrop and also the economic, which we'll get into. So that's one valuation ratio that's really showing the market overvalued. The one thing that's really starting to improve is earnings. So what we're looking at here is the S&P 500 again, 2018 operating EPS, that's earnings per share estimate. So this is just what the market thinks earnings are going to do. So back in March 2017, they thought they'd earn 146 and some change. Currently, right now, we're expected at 149. So we're seeing strong expectations of earnings growth. And we're actually seeing this in the current earnings cycle. So 26% of the companies are reported in the S&P so far as of yesterday, and over 70% are beating the bottom line. Again, they're coming in stronger in earnings. But even more important to me, it's that sales, so revenue, that's that demand side of the equation, is also beating expectations by 70%. So in addition to the estimates going up, we're seeing those earnings kind of come up and actually beat those estimates that have been going up. So again, a strong picture. Again, we are overvalued. We need to see earnings to keep going up. But given what we look in the marketplace right now, we see no reason why these earnings can't keep going up and to the right, which would help alleviate some of the valuation problems we see in the marketplace right now. So switching to economics, and this is really the underpinning of the strong market that we're seeing, that we're really seeing some strong economics out here. So what we're looking at here is jobs. This is jobs in the US, all employees, total non-farm. I'm sure you heard it over the radio being reported once a month. We use a 3-month moving average, again, to kind of smooth out those intra-month fluctuations and take care of some seasonality in the marketplace. And it's not so much the level, it's the trend. Are we creating jobs? And again, the thesis behind this is when we look at the economy, what we really need to do, we just need to increase jobs. If we create more jobs, we create more income for people. If we create more income for people, we get more spending. If we get more spending, we get continued economic growth. So that's kind of the chart that we want to see. And what we're looking at here right now is we're creating a healthy 600,000 jobs a month on a 3-month moving average. But again, the trend is flat. Normally what you want to see is up and to the right, but here the market can still sustain the current growth if we just keep growing at this 600,000 jobs per month. If this stays flatlined, we don't need this to go up to get continued economic growth. We just need it to stay flatlined and not go down. So when we're looking at this indicator, jobs are being created, and we can argue, we can have that discussion, are the right jobs being created? They're not the same jobs that we're getting 20, 35 years ago, but boiling it down to the data points that matter and not taking out the politics, taking out all society's questions, just for the economy, we're creating more jobs, which means people have more money in their pocketbook, which means they can spend more, which should increase the economic activity. So looking at the jobs picture, it's a very strong jobs market right now. My favorite economic indicator that we use is new orders. So this is manufacturers' new orders, excluding aircraft, again, because aircraft make noise in this number, and it's one aircraft purchase is so big that it distorts this, so we kind of pull those out. And what we're trying to ascertain here is, are companies spending? Are they spending on goods? Are they buying long-term assets that will generate earnings going forward in the future? And we use a year-over-year change of a 3-month moving average, again, kind of get out some of the fluctuations in the month-to-month noise. And what we're trying, again, the year-over-year change, are we ordering more goods than we did a year ago? So as long as this is positive, we see the economy in expansion mode. And we have a very strong, almost 9% growth on a year-over-year basis. So this is telling us that companies see a bright future ahead. They see demand, because if they do not see demand, they're not going to order new goods. They're seeing those demand out there, and they're ordering new goods. So again, a very strong economic picture based on the new orders we see here. And we see this continued. So again, we don't want to see this go down. We start seeing it near zero, we get nervous, but for right now, very strong, 9% growth, really supporting this economic expansion we're seeing across the globe. And again, we have global GDP right around 3%. I think it's kind of the last number I saw kind of going into this. It's not extraordinary. We've seen higher before. I do think we need to get that higher to kind of keep this economic expansion going to all folks and not just kind of the top 1%. But again, it's good enough to keep up the stock market if we get this 3%. So in general, GDP and EPS heading in both the right direction. So some other economic numbers out there that kind of supports this global growth. These aren't indicators that we use in our model, but again, these are things I look at kind of month to month to see what's happening in the economy. Top left right here, we look at light vehicle sales. Are people buying cars? Yes, they are. Historically, the long-term average has been about 15.6. We're up about 17.4. We're kind of going upwards to the right, which you would expect coming off the lows of 09, but we're seeing healthy vehicles being purchased. Right below that, we see housing starts. Again, a very healthy housing market. We're seeing lots of housing starts. Housing starts are key. They create a lot of economic demand, a lot of jobs, a lot of economic expansion, buying materials, building houses. Think about how that affects and spreads through the entire economy. You buy a house, you need to go buy furniture or replace furniture. You buy TVs, you buy appliances. All that economic activity trickles down to the rest of the economy. And we're really seeing strong growth in housing stocks. And again, just came in today, so I didn't have time to present it here, but we just got the latest reading on house prices. We used the Case-Shiller index from the CAPE ratio. He also does a housing price index, and that was up 6% year over year. So again, seeing very, very healthy growth in the housing market. Lower right, real capital goods. That's the same number that we use for our new orders. It's just the actual dollar amounts, not the percent change year over year. And again, we're seeing a very healthy, a little bit below average, but right around that average. So again, companies are ordering capital goods. In the top right, which you have to kind of adjust your view, lower is better, this is just showing how much inventory we have online. So if this demand came, which we fully expect, and people start buying goods, are they just sitting in a warehouse where there's no economic activity created? Or as demand and people buy these goods, do manufacturers have to start creating more products? And that's what we're seeing here. The lower the inventory, as demand comes in, the more manufacturing activity you're going to see in the back end, which increases economic activity. So again, taking in totality, the economy is doing well. It may not be doing well for everybody, but taking as an aggregate, which is what matters to stock prices, not a comment on society or anything going on in the political environment, in the economic environment, we are seeing strong growth across the board. So the last piece we want to talk about here is the central banks. And again, what we're looking at here is the US Federal Reserve, BOE, BOJ, which is the Bank of Japan, BOE is the Bank of England, ECB, which is the European Central Bank. Over here on the left, we have their policy rates. You can see the US Fed's up at 150, and you can see internationally they're a lot lower than we are. So we're ahead of the curve in terms of where we're going. And that is one kind of leg of the stool on the thesis why we want to be more overweight international emerging stocks. Because if you think through like the business cycle, you have an interest rate cycle too. As the Fed raises rates, you're going to see the Bank of England, ECB raise rates, but they're going to be behind the US. And since they have a little bit longer runway, since they're behind us in this cycle, we should see more economic expansion and more price growth on the international and EM side. And again, over here on the right, see market expectations, which is what really matters. And this is what the market is expecting these banks to do. And that's what really is the key here when we look at interest rates, because we're reading a lot, hearing a lot about how interest rates are going to destroy this market, that as soon as the Fed starts raising rates, the market's going to fall out of bed. Equities don't like rates rising. But again, they don't like rates rising when you're up at 4 or 5%. When you're down at 1% or a half, even if you raise it the 4 rate hikes we expect next year, and that goes to 2.5%, you're still at a very historically low base on your interest rates, a very easy monetary policy. So the conditions are still very easy. They're not tightening in terms of where, because it's starting off such a low base. What could kind of deter this thesis? Unexpected rate rises. The Fed loses control. The Fed raises 6 times. The Fed says, you know what, I'm not raising a 1/4 basis point. I see lots of inflation out there. We're getting nervous. Let's go raise it 50 basis points. Let's go raise it 1% at a meeting. That's not in my base case. I don't think they're going to do that, but that would kind of throw a monkey wrench into this thesis that a few small rate rises here and there over the next year are not going to derail this market. So again, we really fully expect the Fed will raise rates 4 times. As long as nothing unexpected happens and there's no shocks, we don't think the rate rise of 1% over the next year is enough to deter this market right now. And over here, we can see the expectations for the BOE, BOJ, ECB, and the Fed. And again, definitely shows how the Fed is ahead of the curve compared to other international marketplaces. So again, I talked about those low rates historically, and I like going back and using a lot of data because sometimes recency bias creeps in and we say, oh, wow, it's raising by 50 basis points. This is huge. Well, let's remember where we started from. And what we're looking at here is a 10-year Treasury yield. The blue line is a nominal, so that just takes into account inflation. And then the gray line is the real 10-year Treasury yield, and that just takes away inflation. So again, looking at the last data point, December 31st, 2017, we'll take a look at the nominal rate. That's the real rate plus inflation. It's at almost 2.5%, 2.4. Going back in time, you can see that we're still in a very easy monetary environment. We're not up at that 5%. And for those who remember going back to 1981, it just amazes me that you could have bought a 10-year note in 1981 and got almost 16% coupon, just sat there and clipped 16% in coupon. It amazes me. So when you hear people talk about the rate rise, it's going to be this huge impact to the market, there will be an impact, but we have to remember we're starting off a very, very low base here. It's coming from it's still very easy monetary policy. So again, as long as we don't see a policy mistake, as long as we don't see inflation run away from us over here, we don't think a 1% rate rise is really going to deter the market too much. So again, looking at a long historical chart here, you can see that we're still in a very easy monetary environment, and rates are really still very low compared to where they have been historically through time. So kind of taking it all back to our capital risk model after we looked at a few indicators, again, what are we seeing here? We're still seeing the positive 5. And what we want to do is, how does this risk model influence portfolio positioning? At the high level, but as always, the devil's in the details and individual asset classes coming to play. But again, we see this as a green as a normal state. We're taking normal risk in our client portfolios. And like we kind of started off this presentation with, we do think it really, really matters where you take that risk. So what asset classes are you in? So looking at our current asset allocation, and this is for our 3 diversified portfolios across the board, conservative, moderate, and aggressive. This also, we use the same asset allocation for our carbon light models. Again, we have carbon light models, conservative, moderate, and aggressive. They're all in the same asset allocation. Equities, we're neutral on. Again, very strong economic environment, supported by strong technical backdrop, but you still have that valuation picture. So again, given that rate environment, we don't want to be overweight equities in general or risk assets. We want to be neutral. Again, where do we want to get exposure? We want to be underweight US. Doesn't mean no exposure. We still have a healthy dose of US equity exposure in all our client portfolios. We just, compared to our normal risk level, we're going to be a little bit underweight US equities compared to other places in the market. And where do we want to put those dollars? We want to put them in international developed, emerging markets, which also classifies as frontier markets. So we want to be overweight those. And we've seen that in portfolios. We have been overweight those for the past 3 or 4 years. And again, we're starting to see that translate into performance. When we look back at that 2017 performance, where international EM are really starting to overtake the US. Fixed income, we definitely want to be underweight. We mentioned the interest rate rises. We think 4 is a normal state. We don't think it's too bad as long as they don't make any rash decisions and increase that. But given that rate environment, as I'll show you in another slide, duration matters. So when rates rise, it hurts fixed income products. A bear market in fixed income is a lot different than a bear market in US equities. A bear market in US equities, we're talking 50% drops. A bear market in fixed income, which we fully expect given the rate environment, is you're losing 1 to 2, 3%. Not a great outcome, but not as damaging as a sustained downfall in equities. So we do want to be underweight fixed income, but we do think there's pockets where you can kind of generate some of that return, get some income, and still manage the duration. We're neutral on cash. We just hold transactional cash. Commodities, we talked about, we do think they're in a trading range. I have some long-term concerns about oil, which is the biggest commodity. It's about 65% of all the commodity indexes. I don't think it's sustainable. It's not someplace we really want to be invested in right now. We do like the alternative space. We do like managed futures, merger arb, really asset classes that aren't dependent on the equity market or the fixed income market going up. That doesn't mean they always go up when the market goes down. It just means that they have their own independent return stream, and they're going to be driven by independent factors, not what happens in the market. So if the market goes up, alternatives may be down. They also may be up. It doesn't really matter what the equity market's doing. They have their own individual return streams to matter about. Managed futures is trend following, so it's looking to take advantage of trends across multiple asset classes. Merger arb products are just aimed to take advantage of companies that are buying other companies and take advantage of a little bit of spread that's usually between the deal price and the final closing price. And again, you can see and understand that those aren't dependent on the US market, international, EM, or fixed income going up, which is why we really like that given where we're in the risk space right now. So why do we like international over US? Again, this chart is the S&P 500, which we always used, and the ACWI ex-US. So that includes emerging markets, that includes international developed across the board. The purple line is the price performance, and I'm going to focus right in here on the 09 period. And you can see from the 09 bottom, the US has really ran a lot farther than international market share. But again, given what happened, it wasn't because of earnings, it was what people were willing to pay for it. So we look at the PE, and that's what people are willing to pay for any asset class. The S&P 500, they're willing to pay 18.2 times earnings. Historically, we've only paid 16 times investors have been willing to pay. So again, overvaluation. We go down to international, and that's currently trading at a 14.3 times. Historically, investors are willing to pay 14.5 times. So again, a much better valuation picture in terms of asset classes in the international and the EM. And if we look back, going back even further to 97, back over here, you can see that while the US has always traded a little bit of a premium to the international, it's been very small. The gap has been very consistent and small. It closed here on the big market rise up in '08. Correlations all go to 1 when crashes happen, so they all kind of traded at the same. We do think that gap closes again. So historically, we think it does, history does rhyme, maybe not always repeat, but this gap will show up again. And again, we think that gap closes as internationals increase their price performance and that gap narrows, and we'll see the outperformance of international. So again, when we look at why we will like international over US, much better valuation picture and a much higher dividend yield. So again, all returns start at a dividend yield, and you're earning 3% over in international and only 2 in the US. So much better valuation picture across the pond. So now we're going to turn our eyes to the fixed income market. And we mentioned that we want to be short duration. So what are we looking at here? Well, what we're looking at here is US Treasuries. That's pretty simple. Looking at the yields, their returns, the correlations to the 10-year, and the correlations to the US equity market. Then we see different parts of the fixed income market that you may not be aware of. Convertible bonds, which we hold, and we'll show why. Floating rate, which we very much like given this current rate environment. High yield, we're not so constructive on. Again, it just got very expensive, so it may benefit from a rising rate environment, but given where it stands in the valuations, we don't think it's an attractive asset class going forward. MBS is just mortgage-backed securities, munis, corporates. What I really want to focus on here is a chart on the right, and this is what we mean by duration. So without going into a long, detailed formula about duration, what is duration? Duration is pretty much a measure of what happens to an asset class when interest rates rise by 1%. And that's what this is covering here. So we'll look at these Treasury notes, and let's look at the 30-year. So historically, given price performance, given how the function fixed income instruments work, a 1% rise in interest rates, which we fully expect over the next year, would knock the 30-year Treasury's total return down 17%. Again, it makes sense. A 30-year long duration asset is going to be impacted more by a rate rise than a short term. But across the curve in the Treasuries and the TIPS, which is a good point too, and those are inflation protected bonds, are still negatively affected by interest rate rise. We don't want to be long those assets. We do own some in some of our portfolios here and there sprinkled in for income, but we are not overweight, we're underweight those. While we're overweight, which we talked about, is convertibles and floating rate. Again, this blue line, total return, what happens to the price of these assets when rates rise by 1%, all else being equal? They go up. Floating rate rises. And that's because what a floating rate does is its rate is reset almost every 3 months. So as the Fed raises rates, these companies have to pay more in interest. So that translates into more income for your portfolio. Convertibles aren't exposed to interest rates as much. They don't raise it too much, but they have fixed income streams that don't adjust based on where the rates rise, and they have some equity-like attributes that kind of help that. So again, where we want to take our duration risk, we want to take it in convertibles. We want to take it in floating rate. We also think that we want to invest in funds that can manage duration. So a lot of bond funds out there, what they do is they match a benchmark. They match the Barclays Global Ag, and I kind of stumbled there because I always called it the Lehman. It used to be called the Lehman, and everybody knew it as the Lehman. And as soon as Lehman went under, Barclays bought it. It was probably a great purchase by them. So it's now called the Barclays Global Aggregate. And it's just a big, broad bond index. And most managers are tied to that. So they can't adjust the duration. That ag duration is right up about 6. So they may go down to 5, they may go to 7, 8, or 9, but they have to stay right in that range. We use some other products that have more flexibility in where they manage that duration. So they can go down to a 0 duration, they can go down to a negative duration. And we think that's really going to be key in the fixed income market going forward to kind of help dampen that impact of rate rise. You're taking some credit risk, some more corporate risk, but again, we think you're being compensated for taking that credit risk, where you're not being compensated for taking that duration risk, which is why we're positioned in the fixed income market the way we are. So in terms of also positioning the US stock portfolio, we do run an internal stock portfolio here. Again, we use our internal risk model to help judge where we want to take risk, but we use a multi-factor model. We look for high quality companies trading at a discount to the market that's returning cash to shareholders and have positive price momentum. Where are we finding value right now? Industrials, consumer cyclicals. But again, we do have a decently high cash balance. Again, given those valuation concerns, those companies are becoming tougher and tougher to find, but there are pockets where we do, if we know where to look. And again, we have a good exposure to Boeing, Apple, Southwest, companies that have moats around them, pricing power, and the ability to generate demand given any economic environment. Again, we don't like technology. That's that momentum stocks, those US momentum FANG stocks. We do think they're just way overpriced, and they could be overpriced for the next 1, 2, 3, 4, 5 years. It's hard to tell when, but the day of reckoning is coming in those technology stocks. The problem I have with that is you can never tell when that is unless you're looking in the rearview mirror. So by the time we figure out that technology growth stocks aren't going to work, they're already down 30, 40%, and I don't know how to trade that. So what we're looking for is valuation support, which we can understand and manage. So that's kind of the gist of it. I'm going to do a few final words, and then we're going to take questions here. So in terms of summing up everything, extended valuations are a concern, but we do see the global growth story remaining intact, and I always put that for now. And the reason I put that is we look at the data, and data changes month to month, quarter to quarter, almost day to day. So we're going to let the data really decide where we go with these asset classes. And for now, when we looked at our internal risk model, we look at the economic data points, the technical picture, the global growth story is intact, and we don't see it changing in the future. But we'll let the data tell us when that's going to change. The market's technical picture remains healthy. We looked at the percent of stocks trading above the 200-day, very healthy picture. We looked at a long-term chart with support and resistance going that positive uptrend. The MACD going positive. RSI, which is more of a shorter-term indicator, a little bit negative, but all in all, still a very healthy technical picture. Given that backdrop, you really want to pay attention to where your risk exposure is coming from within the equity markets. Like we said before, we like international over US for the valuation picture. We think that gap closes. We like value over growth, especially in the US equity markets. We think value hasn't worked for a while. Doesn't mean it's had negative performance. It's just lagged this major rise in the S&P 500, and we think that over time that's going to change, and investors are going to start valuing growth a lot more. They're going to start valuing value, if that makes sense, more than the valuing growth. They're paying more for growth right now than value. We think that switches, and they're going to start paying more for value stocks than growth stocks. Central banks continue to intervene in the markets, causing distortions across the yield curve, across asset classes, even bleeding into the US equity markets, international equity markets. It leads to major distortions in asset class pricing. So given that environment, be cautious reaching for yield. Be very nervous about any of those high yielding asset classes out there because they're going to get burned if rates start to rise. And don't chase risk. Be short duration, which we talked about. You really want fixed income instruments that may perform well in a rising rate environment, or really invest with managers that can change that duration given the market conditions, really being able to move up and down that duration curve as they see fit. And then do have some inflation hedges in your portfolio besides equities. Equities are a great inflation hedge. Commodities have been historically, but that's really being driven by that one point in the 70s. We had the big oil shock. Take that out, and then not so great in hedging inflation as much. We saw that TIPS do get hurt, which is an inflation hedge product, but they do get hurt because they do have some duration in there. They are US Treasuries after all. So we tend to like different products. So we have a product, Lord Abbett Inflation Focused Mutual Fund, and what they really do is they take out that duration. So really the only risk they have is inflation. So again, it's all about being compensated for the right risks. I don't want to invest in companies based on duration. What I want to invest in products in terms of, can they hedge out my inflation? So if inflation runs away, that product is going to do well. If inflation stays neutral, doesn't and meets expectations, it's still going to give me some positive return. So again, we think that's a better way to hedge inflation than to go into some of those other asset classes. And remain overweight alternative asset classes. We do think, given where we are with valuations, that the day of reckoning is coming at some time. We don't know when. We don't see it in the very foreseeable future, but having consistent exposure to asset classes that don't need that rise in the markets to go up is very healthy from a diversification standpoint, and over long-term investment horizons has proven to generate better risk-adjusted returns than just being long US equities and long fixed income all the time, that buy and hold product where you just kind of ride the market up and down the full market cycle. Think about a roller coaster. You go all the way down, all the way up. what these alternative asset classes is kind of dampen that. So you don't go all the way down. You may go halfway down, which helps us in terms of limiting the losses, so then we can compound returns at a greater rate and generate a higher portfolio value at the end, which in the end is what we're always trying to do here at Stonehearth Capital Management, is to build portfolios at the right risk level for our clients that help them achieve their goals. And we think we've been able to do that using all these data points out there and all these individual risk models we have. So again, that's kind of the basis of my presentations where I stand here. I'm going to go through the appendix real quick if you want to look at it. These are what we judge performance on those first two charts. Then there's always the prerequisite compliance disclosures. It's just funny, I just did it for our stock portfolio, and the disclosures I use for our stock portfolio are actually bigger than the data I use for my stock portfolio. So I have 2-page document. 1 page is just data for my stocks. 1.5 pages is just compliance disclosures. But again, so if you want to, if you can't sleep at night, I would definitely recommend reading this. So with that, I'm going to turn it over to Amanda. I think she's looking at the chat box here to figure out your questions, and we'll see if anybody has any questions out there. Amanda?
Hi, Chris. Yep, we do have a couple questions. If you do have questions, please feel free to enter those into the questions box, and we'll get to as many as we can. The first one I have is, what are you looking at that would cause you to change your outlook?
Good question. Again, so it's always nice to ask that we give you the best presentation here, what we're looking at for the positive, but what could change this? Again, the data, underlying data changes. We look at it month to month, so economics starts getting weaker. But in terms of shocks to the market, what my major concerns right now is really inflation. Does it run away from us? It doesn't seem to be, although I do think we underestimate inflation, and anybody who's been to the grocery store lately can tell the Fed that they're not calculating inflation correctly. When I go to buy my box of Oreos, I used to have 40 cookies, and now I only have 32, but they're the same price. To me, that's inflation, but the Fed doesn't say that's inflation. So again, a shock to inflation, we get really runaway inflation, the Fed raises rates too quick, and you can see how that would translate into a negative shock to the market. The other major concern I have right now, and it's really not political, it's just more economic, is a trade war. There's lots of talk in the political environment right now about tariffs. We put some tariffs on solar panels, we put some tariffs on washing machines. No country has retaliated yet. I do think that may be coming. And sometimes when we overstate the rhetoric, we start doing trade wars, and that will hurt global growth. If trade gets reduced, global growth gets reduced, and that's a shock that's not priced into the market. So again, we're monitoring those things closely, and we'll use that risk model we have to kind of judge when we need to adjust our risk expectations. But right now, it's a good environment, but those are things we're really worried about now.
Chris, the next question I have is, you mentioned the stock portfolio. How has it performed?
I wish I could tell you, but again, I'm sorry, but the SEC could not talk about performance on this call. I can say that we're very happy with the performance, and I kind of leave it at that. And if you really want to talk more about that, please give the office a call. I'll be happy to discuss it all day long. Give us a call or send me an email, and we can set up a call to discuss. So sorry about that.
No, that's okay. Do you see interest rates returning to past levels like we saw in the 80s?
Again, I don't think so. I think, it is the new normal. It's a new interest rate environment. I do think sometimes humans learn from their mistakes, learn from the past, and I don't see rates going up anytime soon to that 15%, even double digits. I think that was a very unique time in history. I do see rates rising. Again, 2.5 wouldn't shock me. A couple years from now, 3, 4, 5% wouldn't shock me. I love to see it. It helps savers. I mean, again, one of the fallouts of this Fed policy is that it hurts people who are saving. You used to be able to go in and get 5, 6% from a bond safely. You can't do that anymore. You're getting 1 or 2%, and you're being forced out the risk curve. So I do think rates, and maybe it's a little bit of hope on my part, go back to being more normal 4 or 5% in the near future. So I do think they're coming at higher levels, but not back to what we see in the 80s.
How does Trump affect your portfolio positioning?
I knew I was going to get a Trump question. I give presentations, here and there, and in the industry and stuff, and it's always a topic of conversation. We really don't use political that much in terms of our investment horizon. It seems to be transitory, doesn't impact the markets. As much as each president, and every president does this, they kind of tell what their impact was to the economy. Quite honestly, they have very little impact. to the underlying economic data. They can make a little bit of impact here and there by some policies, but again, they can only talk about it. They don't pass laws. They don't write the budgets. It's other parts of the political environment, and typically Congress, that can change that environment. I do think it hurts us as a society, seeing this big dichotomy and, the political conflict we see. It's not healthy for our economy, not healthy for our society. But in terms of what we use, other than I now look at Twitter every day when I wake up in the morning to see if he said anything, other than that, we really don't use political data to kind of judge an investment environment. It really has no impact on the long-term investment horizon.
Chris, given the recent performance, shouldn't you be invested in 100% equities?
Yes, but again, you got to remember, every presentation kind of starts past performance. There's no indicator of future performance, and there's a reason why it's out there. It holds true. It's kind of like quarterbacking a game that's already been played. Yes, it would have been great to be just 100% U.S. equities in the bottom of 09, but think about 09. How many people would put all their money in Bank of America, or all the money in JP Morgan, put all the money in U.S. equities and ride out that? And we've still seen, 8% drops in the market. And if you had all your money in the U.S. equity and you see this volatility, how likely it is that maybe you sold when it was down 8%, so you didn't get that full performance. So we don't think it's healthy for anybody to put 100% the money in the U.S. stock market. It has increases volatility. We believe diversified portfolios are the basis for any good investment portfolio. So it would have been nice, but again, there's no way to predict the future. And the just tremendous amount of volatility in U.S. equities doesn't make for a good investment portfolio. It's more speculating than investing. But again, having a healthy dose in a broadly based diversified portfolio with multiple asset classes, then having a good dose of U.S. equities does make sense for the long term.
Chris, can you just expand on what the Carbon Light portfolio is?
I'm sorry about that. I did mention that. I was thinking about that too after I said it. It's probably something I should probably put a chat on. Maybe next webinar, which is coming up in April. I'll talk a little bit about our Carbon Light portfolios. But in general, just so people know what they are, is I've always been interested in the environment, something I'm near and dear to my heart. I think climate change is real. I think it's happening. Doesn't matter if people think that or not, but it's something that we want to help with our clients. So if you believe climate change is real, and the way we look at it is, if you want to have your personal values influence your investment portfolio, we want to come up with a solution to allow you to do that. And what we kind of created is what we call a Carbon Light, and it uses a carbon footprinting analysis to calculate how much carbon your portfolio is emitting. Again, your portfolio doesn't emit carbon. It's the underlying companies within it that are actually emitting carbon, but it gives you a number to see. And what the goal of that is, those Carbon Light portfolios, is given equal the same risk as a diversified portfolio, similar expense ratio, but reduce your carbon footprint. So again, aligning your personal values with your investment portfolio. So that is a good question, and I will put some slides in next quarter to kind of go over that portfolio a little bit more.
Chris, we just have a couple more here. What is the biggest risk you are watching right now?
I think trade war. Again, I really think the rhetoric about trade could derail this market. I think you're seeing a little bit of that in the recent couple days performance here. There's the State of the Union tonight. Things usually come out of that. We set policy going forward. So I think that's what people are being a little bit nervous about. And what really keeps me up at night is there a full-scale trade war? Now, again, not my base case. I don't think it's going to happen. I think cooler heads prevail. We step back, and the economic expansion keeps going here. But again, something that's that shock that just could come out of nowhere, come out of left field to really disrupt these markets, that would be my number one, trade war. And again, it's tough to predict. We'll see it when it happens. The one thing we want to keep in mind is that we know how to react to it. I know what to do with portfolios if that were to happen. We know how to reduce risk. We know how to move to different asset classes and stand ready and willing to act if we see that happening. So that's my really major concern right now, is a trade war.
Okay, in respect of everybody's time here, I think I'll just give one more, and if we didn't get to your question, I'll have Chris reach out to you privately after the webinar. Chris, the last question, is the economy really that strong? I keep hearing that the economic growth is not that strong.
Good question. I hear the same thing. Depending which news channel you listen to, depending which newspaper you read, what website you go on, who you talk to, what part of the country you're in, all that matters in colors your perspective on, do you think we're in economic expansion or not? We kind of cut through all that emotion, I'll cut through all that rhetoric with just the data. We look at what's worked historically, what has shown to be a good indicator of the current economic environment, and we use data to kind of guide it. So we look at jobs, we look at new orders over time, we look at copper. So all the data points we look at that take out all the biases and look at the economy in aggregate. Again, not individuals' personal experiences, but the country in aggregate, and all that data is pointing to a strong economic environment. We're seeing it across the board. So again, at the aggregate level, very strong economy, but there are definitely pockets of weakness in different parts of the country, different parts of the globe, but taking an aggregate, it is really a strong economy. And again, the one thing I always point to is data can't lie. You can color your conversations, you can color your rhetoric, but you can't change the data. The data is what it is, and the data we look at is pointing to a very strong economic environment right now.
Chris, I think in respect for everyone's time, we'll wrap it up there, and I'll have you follow up individually with any questions we didn't get to today.
All right, thank you, everybody. Thank you for joining us. And again, remember that we'll have this every quarter, so we'll be doing this again in April with different data. Things change month to month, quarter to quarter, and we will do have a few slides on the carbon light portfolios. I do think clients will be interested to see how we put together those portfolios. Again, thank you, and I hope you have a great start to the new year.